Hello, everybody, and welcome to the webinar of the Global Islamic Feeder Fund. Thank you for attending today. We appreciate your time. I'm here with my fellow co-portfolio manager Fawaz Fakir, and I'm Maya Jakut, and we are co-portfolio managers on the Old Mutual Global Islamic Feeder Fund.
Good morning, everybody. Good to be here with you. As Maya said, the two of us, the Global Islamic Equity Feeder Fund, which we're excited to talk to you about today, and excited to tell you what this offering can do for you, what it offers investors, and to speak you through some of the benefits and how it can benefit you. So I co-manage this fund with Maya, as Maya said, as well as we work within a boutique called Customized Solutions, which looks after roughly 200 billion rand. And the area that Maya and myself works in is almost ethical based. We look after the Sharia proposition, which Maya will talk to you about, the four capabilities within the Sharia proposition, as well as the active ESG funds. So it's got an ethical and moral based investing proposition behind it. Maya, over to yourself.
I'm going to move over to the slides now. And hopefully everybody can see that. So we're going to talk about the overview, and then we're going to talk about Sharia compliance. This is a Sharia compliant fund, and how we make money for investors, which is really our philosophy. And then we're gonna move on to how we do it. So exactly from the start of the universe right through to how stock ends up in the portfolio. Then we're going to touch on performance and talk about longer term and shorter term performance. The market is currently very volatile. And then I'm going to conclude. And once I'm on the conclusion slide, I think it's important that we're going to take questions then. So I understand in these type of scenarios, some people get stage fright. So there is a question box that you can please jot down all your questions. My experience doing this is that we hardly ever get through all the questions. People are excited, people want to know more. So in that aspect, what we will do is we will then email you the answers if we don't get to your questions. So please understand that. What we have also done is uploaded the presentation in PDF format for download. So just in terms of the Sharia team, which sits in the broader team, and Fawaz and myself are really here representing the broader team and OMIG. While we are the portfolio managers, we are representing the broader team, which is headed up by Kiam Hamilding. Kiam's responsibility is not just the head of this team, he is the head of our passive team as well as our risk managed team. So he's got a lot of accountability on his shoulders. And then the guy that actually smiles the most in OMIG is actually the serious guy there, which is Mario. I don't know why he's so serious in that photo, but he's our head of research. He came to us from Prescient, but prior to that, he actually worked in this very team on these funds. So that's the broader Sharia / I would call it ESG / what Fawaz had mentioned, ethical franchise team. I want to pause on this slide for a bit because this really gives the audience a complete view of our entire Sharia range, starting from the most conservative to, I would say, probably the most aggressive. So it starts with the Old Mutual Baraka Income Fund, which has a 10% of equity, and then you've got 90% of sukuks. That fund has done very well, but in saying that, income funds generally have done well over this volatile time. We move then over to the Old Mutual Al Baraka Balance Fund, which it's important to note here, if you add up the global equity portion as well as the SA local equity portion, it adds up to 60. So we are mandated to a 60% regulation 28 balance fund. However, you can get a reg 28 balance fund in a 75% total equity. We do that for segregated clients by merging the Old Mutual Baraka Equity Fund to the Old Mutual Baraka Balance Fund to give you that 75%. Then we have the Old Mutual Baraka Equity Fund, which is a pure equity fund split local and global. Currently, we've got 25% in global and 75% in local. And then the star of the day is the Old Mutual Global Islamic Equity Feeder Fund. Now, while we are going to talk about the feeder fund today, we have been running a global fund for a very long time, and it's got a very good long-term track record, which you will see on later slides and performance. The icons below are linked in some way to the funds, either through process or through compliance. But the important number there is 1992. So I'm going to debunk some myths here. I should ask the question for you guys to actually answer this in the question box. But the 1992 is actually the inception of this fund. It was first called the Southern Pure Fund, right, which was one, if not the first, ethical Sharia compliant fund. Now, in the market is a narrative actually that we are not the first Sharia compliant fund, but actually 1992 is the inception of our fund, from when it was the Southern Pure Fund, and then it became the Future Growth Fund, and has now morphed into the Old Mutual Al Baraka Equity Fund. The South African Muslim Charitable Trust is just where we pay over our non-permissible income, and I'm going to cover that in the Sharia compliance section. And the OFI rules are really rules that Sharia compliant funds use and Sharia compliant managers use around the world. It's very broad, but there are some rules from a quantitative perspective to make a fund or a share Sharia compliant. And then, of course, naturally, there is an ESG tilt, and we'll touch on that on the slide later on. And then our Ideal Ratings is one of the largest Sharia screening businesses. We subscribe to that, especially on our global fund. And then our fund is also externally audited. Do we need to do that? Probably not, but it gives the investor a level of comfort that this is actually a certified Sharia compliant product.
Yeah, and there's about 8.5 billion rand invested across the 4 propositions at the moment. So that's the fund assets under management, the fund size, or the capability.
Thanks, Thomas. So just a few facts about the fund. So it's the feeder fund is a pure global equity feeder fund. So what you're going to find inside the fund are shares like Microsoft, Apple, etc. The benchmark is the S&P Developed Markets Large and Mid-Cap Sharia Index. Well, that's quite a mouthful, but that's the benchmark. But the important takeout of this slide, I think, is who is this fund for? And this is really for a long-term investor who's seeking capital growth. But I think I need to emphasize on long-term. I think that's the most important thing. If we look at the risk profile, it is moderate to high. But if we look at the minimum investment term, it's 5+ years. Personally, that number should probably be 7 years. And then on the fact sheet, you can find the investment minimums. So why would you invest in a fund like this? You're getting access to the best of breed businesses. So in our process, in our philosophy, Fawaz will touch on how highly selective we are with choosing those businesses. And then just in terms of, it's a liquid investment, so you have access to your funds at any time. And then in terms of offshore exposure, we're investing in companies that you are not going to get exposure to in the local market. So what does this help with? It helps with diversification of your portfolio and diversification of returns. It's a fully Sharia compliant fund where we pioneered the non-permissible income, which I will touch on in the compliance section. In terms of the country allocation of the fund, so I mentioned a few shares, just in terms of what we're looking at, and I just mentioned 2 there from Microsoft and and Google in terms of just knowing those brands. But there are other brands like Nike, Adidas, Kimberly-Clark, which will resonate with most of you, as well as Ferrari, L'Oreal. We know those beauty products, as well as Zara. It's not called Zara on the stock exchange; it's called Inditex, um, but but that's the owner of Zara, which we see now more. From a country allocation, you can see that it's largely US. And in our positioning slides, Fawaz will take you through if we are underweight or overweight the US. And then it's split up. The balance of that, I would say, 35 to 40% are in Germany and the Euro area, like Netherlands, as well as the UK, France, etc.
Yeah, I think it's important to mention as well that we invest largely in developed markets as well as in large and mid caps. So it is fairly liquid, as Maya mentioned, fairly liquid companies and in the developed market space.
Thanks, Fawaz. And our current investors. So I mentioned our long-term track record with the UCITS specifically, but what we are launching is the feeder fund. So you are getting global exposure, but you invest in ZAR. We convert your ZAR or your rands into USD, and then we buy the various companies to give you that exposure. But just some of the investors that are currently invested with us. Now, while you may not know ISDB, which is Islamic Development Bank, which is the largest multilateral finance institution in Saudi Arabia, you will see or recognize some logos there, such as Discovery, Sanlam, Alexander Forbes, Stanlib, which are all invested in our global fund already. So to move on to Sharia compliance. So this is very interesting because when Fawaz spoke about ESG, right, and Sharia, there's quite a close alignment in terms of what we exclude. And that is really that middle column over there, which is alcohol, adult entertainment, gambling, and tobacco and weapons. The takeout out of this slide, however, that we can all agree upon is that, well, lots of fund managers are including ESG in their process. Now, Sharia compliant rules have been there for over 1400 years, and that hasn't really changed. I mean, just looking on the ESG side right now, in terms of weapons, people are saying, well, there's a war going on. Shouldn't a weapons company or weapons manufacturer be included in ESG from a safety point of view? I don't think that that's ever going to happen in the Sharia compliance space. But however, in saying that, it's very important to know that there are strong inclusions. So naturally, a Sharia compliant fund is going to be high in ESG.
I think the key difference when you look at that is on the Sharia side, the material difference is we take out highly levered companies. So all your basically your financial sector is excluded. And on the ESG side, your big exclusions there are generally your carbon intensive industries or the fossil fuel heavy industries. And those are the material differences amongst others that are listed.
Correct. So just to put that process into perspective that Fawaz was talking about, on the qualitative side, you're going to get the middle column. So the alcohol, the tobacco, the adult entertainment, weapons, gambling, etc. So where business's core is linked to those activities, they will be screened out at the beginning and they won't even make the quantitative test. The quantitative test starts with the OFI rules, which is one of the icons that you saw at the beginning of the presentation, which is the Accounting and Auditing Organization for Islamic Financial Institutions. This body regulates certain ratios. One of those ratios, as Fawaz had mentioned, is a debt ratio, which is a 30% to asset value or market cap. Once the universe has passed that test, it now becomes investable. Then incorporate ESG is through our through a scoring system, and we've got a fully fledged ESG team which only works on a proprietary metric which feeds into our portfolio construction. So in terms of what tayyib means there, so in the Quran, there's a surah or verse that says, eat of what is halal and tayyib. So while something is halal, it doesn't necessarily mean that it's good for the environment. So incorporating Sharia compliance as well as ESG, we cover the broad spectrum to give you a quality Sharia compliant portfolio. And then just in terms of the non-permissible income, which I said I was going to mention, that is paid over to the Muslim Charitable Trust. So every single company that we invest in has an income statement, right? It's listed as an income statement, and there are certain non-permissible activities, so such as interest income. So they don't perhaps have a Sharia compliant bank account. So what we want to do for investors is we want to strip out that non-permissible income, which we do on a daily basis. So that gives the investor comfort that the unit is purified going into the investment as well as exiting the investment. Because we must understand that certain individuals saving, using this fund as a savings vehicle, could well be saving for pilgrimage. Okay, so that's what we mean by non-permissible income. We strip out the interest income from those companies that accrues and we pay it over to the trust. The trust is an independent body. What does the trust do with that money? It gives to education projects, health projects. A big beneficiary of the trust is Red Cross Children's Hospital. Now, while the name of the trust is called the South African Muslim Charitable Trust, all four funds within our business contribute to that, and we are the only contributors to that trust. But while the name is the South African Muslim Charitable Trust, it's not just Muslim organizations that the funds are going to, right? And that you can see from the slide as well. And then I mentioned that the Red Cross Children's Hospital is a big beneficiary. I'm going to change over to Fawaz now to take you through how we make money for investors as well as how we do it.
Thanks, Mike. So we are in volatile times at the moment. I mean, there's a lot happening in the world, right? We sort of put some of the concerns, the global concerns right now on sort of one slide. And I mean, even if you don't follow financial markets closely, I mean, you'll be very well aware that some of these things are going on because we feel it directly, on our pockets. So I mean, we have geopolitical tension. We have the Ukraine-Russia war that who knows when that's going to end. We have house prices going up. We have interest rates tightening. We have the highest inflation we've ever seen in a while. So things are not looking all rosy for financial markets for us in terms of our wealth and in terms of just the economic growth in the world right now. We've enjoyed quite a good period over the last few years, but that ended sort of towards the end of last year, beginning of this year, and it's a very, very different arena that we play in now. So some of those things are, global growth is definitely slowing. I mean, in this fund, and I'll touch on it a bit more later, the benchmark that we have is down around 25% for the year so far. And geopolitical tensions, squeeze on food prices that we're all feeling on oil, petrol's through the roof, and companies' profits will be affected by this in the next few months or who knows for how long. But I mean, we're not living in a period where we expect huge bull markets anytime soon. So it is quite a slow recessionary type period that we are in.
I think if I can just add to that, the question in the room should be, is it the right time to get in? When markets have come off this much and certain certain things are priced in, especially in this volatile arena. If you have the time on your side, you should be asking yourself the question, is this the right time to get in?
Against that backdrop, I hope to give you some more color as to around how we make money and what our investments philosophy and strategy is in terms of the companies that we try and identify and hold in this portfolio. And we really have a quality and valuation philosophy. And what that means is we look for good quality companies. That entails companies that generate consistent earnings, consistent return on assets, return on equity, consistent return on invested capital, so consistent profits year after year. Companies that are well capitalized, that have good, strong balance sheets, they don't need to take on a lot of debt to grow. And that complements the Sharia strategy quite nicely. Because as a natural low levered sort of angle to the companies we hold. And coupled with that, we're also looking at how companies have grown their profits and what they'll continue to do in terms of growth, very important. But also we want to buy these companies at the best possible price, right? We don't want to pay, it goes without saying, we don't want to pay too much for them. So valuation is a cornerstone of what we look for as well. If one were to use a car analogy, if we go out and buy a car, we often look for a good quality car. So you might think of Toyota as being reliable. So, but you also want to go out there and buy at a good price. So you compare, what cars cost across various competitors and stuff. You might identify the German brands as having high quality interiors and the brand value, but you also want to pay the cheapest possible price, and that's no different in the companies we look for. I think a key source of value add for us is being able to identify the best quality data that's out there in terms of companies, the data that drives stock returns, and converting that data quickly into investment insights to enable us to make money for you. In terms of how that looks, we started with a share universe, various shares that are Sharia compliant, and we look for high quality businesses with some of the traits that I mentioned. Another high quality trait is a business with a strong competitive edge, something that can't be eroded easily. And once we've identified that subset of high quality businesses, we look to buy them at preferably attractive prices, but if not, then fair prices. But quality businesses tend to be expensive in general, so we're trying to identify the subset of attractively or fairly priced shares there, and those are our high conviction buy shares.
Yeah, I think if I can just add to a high quality business, sometimes when you're in this volatile arena, as we discussed, certain companies get smashed, but it's overdone. Nothing's changed in terms of their business. Nothing's changed in terms of their cash flows. It's still a very good business, but it just gets oversold due to lower growth in various markets, etc. And that's when we actually want to pounce. But the question that we ask ourselves is that a structural thing or is it temporary? And if it's temporary, well, then that's where you predominantly probably want to add. And that's how we do it in the portfolio construction process. And if it's actually structural, then you actually want to steer clear because you want companies with growth levers, right, that are quality, but that are oversold. And that's the thinking around how we get those portfolios or funds or stocks rather into our portfolios.
So thanks, Mara. So everything we do is numbers based, right? And we've identified an independent source, MSCI, that many of you will be familiar with, and looked at what they, amongst various other research we do, what their world quality index has done over the past 34 years to be exact. versus their vanilla parent benchmark index of the MSCI World, and it's generated about 3% of outperformance there relative to the global market. And it's consistent in various markets across the world. So it's quite a robust finding. And if you look on the right-hand side, if we isolate the value factor and then we combine value with high quality shares and value with low quality shares, we find a combination actually works very well across US, Europe, and Japan. And this is tested over like a 30-year period. And we find very much the same thing holds in emerging markets as well as in South Africa. So the evidence is there. This is just an independent source we use, very high level study, but I mean obviously we conduct much more granular and intense research on the data we use to define quality and value within our investment processes. We zoom into Microsoft. Microsoft's a company that over a 17-year period from 2001 to 2017, they grew their revenue substantially and consistently, as well as their free cash flows consistently over the 17-year period, which is one of the key things we look for. And I mean, if you look at just these two metrics, I mean, we absolutely love Microsoft from this point of view. I mean, they're doing all the right things from a revenue and profitability perspective. But I think it's very important to know that if we look at the price of Microsoft over the 17-year period, they were actually flat. So if you look at around August 1999 to the 2000 mark, all the way through to the end of 2017, if you'd invested at the turn of the millennium, you would have actually been flat and you would have made no money despite it growing its revenue and free cash flow consistently. And that shows that everything was priced in at that time. And if one were to not look at where the share price was or discount value or relative value at that point, that one could have made a sort of a bad investment decision. So it's important to view them in tandem. In terms of how we do it, to give you a high-level overview of the investment process, we start off with an investment universe, which is basically a subset of shares that are given to us by our Sharia board. And our Sharia board is an independent board of scholars who sit separate to us and identify which companies are halal and which companies are not, as per the framework that Maya presented earlier in terms of the quantitative and qualitative tests. So that's done independently, and that is given to us as portfolio managers in terms of so that we know what the universe or the subset of investable shares we have comprises of. Once we have that universe, we then apply our valuation methodology to those shares. So in terms of so you would have probably picked up that we're looking for companies with specific attributes in terms of quality and value, and the companies that score well on those metrics will get a high forecast score, or they'll be more undervalued. And all things equal, we want to hold lots of those companies or big weightings in those companies versus lower weightings in companies that don't score too well. And it's a very systematic and methodical process that we follow. I mean, we bring ESG in there as well, as Maya mentioned. Companies that score well on ESG, which has a high intersection with Sharia in terms of high commonality there. Companies that score well will also have a higher forecast. And once we have that, basically you can view the end of step 2 as we know which stocks are attractive and which ones aren't. And then really step 3 is about bringing it all together, taking all those stocks and putting it together in a portfolio construct. The more attractive shares getting a higher weighting and the less attractive shares a lower weighting, but obviously there's things we need to be cognizant of, such as, we need to manage liquidity, we need to diversify across the across various companies. We can't hold all our eggs in one basket. So it's stringently risk managed. We manage volatility as well, and we manage sector constraints. For instance, we don't go more than 10% above or below any specific benchmark. And really, once we've taken that into account, that we have our final portfolio. Some of the businesses we hold. So I've been talking about high quality, well priced businesses, and you'll see a lot of names there that you recognize. So you have your alphabets, which is Google. You have Meta, which is Facebook, Apple, Microsoft. So there's some tech giants in there that you get exposure to. Tech has run quite hard, as many of you know, up until the end of last year, as I mentioned, but they've come off quite significantly, and they're actually showing pretty good value relative to the historical means now. So we actually, for Meta, for instance, a big favorite of ours, they're trading at a forward PE of 12, which is almost unheard of in the FANG stocks or the big five technology stocks. And you'll see some of the other names. Novo Nordisk, for instance, our top holding, is the biggest insulin producer in the world. They produce over 50% of the world's insulin. And very defensive company, naturally, because diabetics obviously need insulin all year round. It's the kind of companies you want to hold in an environment like this, given the backdrop that I mentioned. You'll see a couple of other big healthcare names there, such as Merck, Vertex, and these companies are generating good, consistent profits. They're valued quite well, and their earnings don't get affected by a business cycle. So they've been staples in our portfolio for quite a while. Another company there is Applied Materials, one of the biggest semiconductor and display equipment companies. Also a forward PE of around 12, very good return on assets, very well capitalized. And those are the kind of businesses you want to hold in times like these. And another one, just before we move on, is AutoZone. They've been also in our top 5 for a while. They're almost in the defensive do-it-yourself auto market. So they sell auto parts. And given the tougher economic backdrop, motor vehicle owners are looking to maintain their cars themselves, and avoiding new car purchases right now. And that market, that company has just consistently delivered good earnings. So they've been a favorite of ours for a while, as I mentioned. Just in terms of sector positioning, we do like healthcare, as I mentioned, and as you can see, and defensive type companies. Also, we are underweight the United States. Mike showed you that the US comprises a huge part of our benchmarks. We think the United States is kind of overvalued, and it's kind of looking expensive relative to the rest of the developed markets in terms from a relative value perspective. And we think it's running quite a bit. So it doesn't look as good as some of the European countries like Canada, Netherlands, and even China. In terms of the quality metrics, some of them that we look for, that we identify within companies that I mentioned earlier, is return on assets, cash flow, return on invested income, your gross profit margins. If we roll it up to the fund level and we look at it versus our benchmark, we want to be favorably positioned against our benchmark on those metrics, given our bottom-up portfolio construction approach. And we often look at this and monitor this to make sure that we are, in fact, doing as we say, reflecting our investment philosophy in our portfolio. And as you can see, we stack up quite favorably there. The one that's lower is total debt to total equity, which is obviously we want to be in more well-capitalized businesses, as I mentioned. So that you'd expect to be a bit lower. Then on the valuation side, earnings yield and cash flow yield is also significantly above the benchmark. So true to label in terms of our investment philosophy, and it's reflected in the numbers. So
Yeah, I think we can't iterate more in terms of doing what we're saying and saying what we're doing. So if you, as a portfolio manager, say that you're actually tilted towards a quality, growth, and valuation, well, then that should come through vis-a-vis your benchmark. And I think that's the important takeout for this slide. We're going to shift onto performance, and the slide you see in front of you is a USD performance. So you can see in terms of the other players and how this is ranked is basically twofold. It's one, businesses that had the same track record, and funds that are actually actively managed. So we don't have any indices on the slide here. And that performance there, I mean, while you look at it, please note that it is in USD. And then just in terms of being an investor in this fund, myself personally, you need to look at what you're getting yourself into in terms of the philosophy. So if you agree with that, and then you move down, you say, well, what is global returns going to do? And if this fund is delivered 8%, and I'm investing in ZAR, then it's converted. Well, when I sell out and it's converted in back into ZAR, the USD, then what does that ZAR return look like? So that, if you look at the ZAR depreciation since 2012, I was looking at a graph last week. You're looking at about north of 55% ZAR to USD depreciation. So what does that do to the fund's return or to your return as an investor? It actually adds, right? So when you do the conversion and you say, so what is my return actually in ZAR? You actually here, for the same time period, you're looking at about 15%. Now, back to my question right at the beginning or through the middle of the presentation, I asked, well, global markets have come off, the US is run hot, there's inflation, in Europe side, there's inflation, and you have the energy crisis. Stocks have come off, markets have not done well in absolute terms. So if you have the time horizon and you can invest in a fund like this, whether it's Sharia compliant or not, but if you're specifically looking for a Sharia compliant fund, then I think for me personally, it's the right time. It's the right time to invest. And then also, when looking at this fund, and if Sharia compliance is actually not an issue, please compare this performance to other global funds out there. Because I do feel that sometimes when we talk Sharia and we talk Islamic funds, it's put in a bucket for somebody that is looking for that specific fund, which I don't think is correct. It should be treated as another asset when comparing performance and both philosophy. And in this case, specifically, a lot of people talk about ESG, but are we really talking about impact, right? So that small amount that comes off every day on an 8 billion rand pot, that probably equates to this year, I think it was 27 million that is going to charity. Now, while that sounds big on an absolute basis, it's actually very small. But now we're talking impact, and we're saying, okay, wow, yeah, I'm investing and doing good at the same time, which I think is extremely important, where the fund is delivering performance, and in the same time, while the investor's getting a return, the investor's also doing good. So if we can just separate impact from ESG, and people often talk about the SDG goals. There are about 17 of them. I was just screening those goals that the UN had put out from a sustainable development goal perspective, and we actually, through the trust, cover 13 out of those 17 goals, which is phenomenal. So this is really close to our hearts, Fawaz and myself, in terms of how we invest and how we also doing a good job from an impact perspective. So we're going to move on to the conclusion. this fund is situated in a business with a trusted brand and a long-term track record. There are no lock-ins. It's a liquid investment, so you have access to your money at any time. It's a leading Sharia governance process. We get externally audited as well, as I mentioned. So people really have comfort. Investors have comfort in investing in this fund, knowing that we are doing the right thing. And you're getting exposure to great companies. All those names that we've mentioned, those big brands, you have access to that. And access to businesses that are not in SA. Yes, absolutely, there are dual listed businesses locally, and one could argue that 65% of the JSE is also the revenue comes from offshore, which is correct, but this is a pure offshore play on where you actually cannot get those type of businesses within the JSE. So this is really a great diversifier and exposure to international markets. And I think the most important thing on this slide is Fawaz and myself are incentivized and locked in to this fund. So if we make money for ourselves, or if we make money for our clients rather, then we make money for ourselves. So thank you. That's the end of our presentation. I see we've done it in very good time. We're going to move over to some questions now, just to see what is inside the.
Please pop the questions in the chat box, and we'll try and address them. Whatever we don't get to, we'll definitely reach out and answer all the questions afterwards.
So the first question here, your performance versus Sharia peers, how have you done versus your benchmarks, which is most important, as that which active managers do not beat the global? Yes, so this is an active fund.
You can say read out the question maybe a bit clearer.
Okay, so this is a question around performance versus the Sharia peers. And the question is about active managers as well as how have you done versus your benchmark. So over the short term, we've outperformed significantly actually, and there are reasons for that. Our benchmark specifically, as we mentioned, is USA heavy, which is one of the slides that we had up there. But also when Fawaz was looking at the positioning, he was speaking about how underweight we are in tech. Okay, so let's just put this into perspective quickly. Tech, over the last few years, prior to 2022, ran exceptionally hard. COVID was an accelerator, it was trading at extreme multiples. Okay, if you were underweight tech, you would have underperformed. Okay, so that's the one thing. So over a 10-year period, the USA has run hot. It's got massive PEs, just looking at it from a country perspective versus Europe, and also wasn't hit that hard in COVID. So going into COVID, if we put it into that perspective, we were underweight tech and we were underweight the US, which caused us to lag over the longer term. Over the shorter term, however, right now, where tech has come off, we're underweight tech, USA has come off, we're underweight the US, and we've outperformed. So that's giving you an answer with some context over the longer term and the shorter term.
Thanks, Mary. So I'm glancing at the other questions, and one of them are, if I were to make this part of a portfolio, what sectors other than those specifically excluded would be downweighted or avoided versus a traditional equity benchmark? So I can make these up in my other fund exposures, i.e. versus resources or financials. Yeah, so I think we touched on, what the big exclusions are. So this fund won't have hardly any financial companies in due to the interest component. So definitely very underweight financials or zero exposure to financials, which if one would like that, one could get it elsewhere. And then the other big exclusions is So it would have oil and gas. It would still have oil and gas companies, which is actually showing very good value at the moment. But I think just yeah, in general, especially when you look at a global benchmark of this nature, in terms of the developed world, the financial sector would be the big one. It won't be any specific other sector. I mean, you'll have your alcohol, your tobacco, your weapons manufacturing, and the industries we spoke about that will be screened out. But from a gig sector or big sector perspective, it's the financials that's the big one.
Thanks, Boaz. So we got some comments rather than questions here. Solid, my heart is happy. Thanks for that. And then there is what is the unit trust price? And then there's also what is the investment cost? So those type of questions, those operational questions, we're going to leave to our retail directors, such as Lisa and Honsi, who heads up that team, who will get back to you on that pricing, etc. There is a question here. So do you think it's really a good time to invest? Yes, absolutely. I think markets have come off, and for me, you can never time these things. It's crystal ball, but I think where valuations are at now, maybe there's a little bit more damage to come, but you can never time that. So I would say, I would say get in, and then do you invest in global sukuks? Okay, so from a sukuk point of view, which is really an Islamic fixed income bond, if I can put it that way, and there are various differences. So the first difference would be that actually on the sukuk side there has to be an asset on a bond, not necessarily. So for the capital raise, there has to be a Sharia compliant asset, and then also a sukuk holder is also linked directly to the management of that asset. So there is the risk that the asset itself is not looked after, and then at the time of exit, you have that risk that you may not get your principal back. On the bond side, it's principal, you get it back, and the coupons, etc. So those are really the main differences to give the audience a context of what a sukuk is. However, global sukuks, a year ago, I can tell you when rates were 0 to negative, it really wasn't attractive, at least not for this fund, but for our income fund. They are looking a lot more attractive now. We've seen 300 basis points of rate hikes. Are they going to get the interest rate, the prime up to 4.5? The European Central Bank is also hiking. How long can it go on for? Is it higher rates for longer? Probably. Is the recession going to happen? Probably. When? That's another crystal ball question. What we can say that based on the info we have, the US will probably go into recession, but we'll probably try to drag that out as long as they can. So globally, we are looking into it from a sukuk point of view. Rates are getting better, and that will affect the rates that we get on our sukuks. So we are looking globally, most likely Malaysia, and locally there's a lot going on in that space. So that's a yes. We are looking into it. We're not currently invested in sukuks globally.
Thanks, Mario. I think we can take one more. We have a question here saying Meta, aka Facebook, has lost about 60% in the last year. I did mention we like Meta at the moment. What risks is the market seeing, and how has this impacted your exposures? So it's not a case of Meta alone. It's actually all tech stocks, as I mentioned when I put up the sort of the volatility or the volatile state of the world at the moment. The place that feels it the most is often your growth type stocks or your tech heavy type stocks, where a lot of the the price is driven by expectations or future earnings expectations, which is quite big in that space, especially amongst the FANG stocks. And really, all of them have felt it the most this year. We actually saw, your Facebooks, your Alphabets, your Netflixes, actually exhibiting some value now at the moment, believe it or not, given how it's come off. They're looking attractive from a valuation point of view, especially seeing that growth stocks and, have come off a bit, and the outlook for growth stocks is not going to be too optimistic anytime soon by the looks of it. So, we are seeing the tech stocks being, including Meta, somewhat attractive, as I mentioned, from a valuation point of view, and as well as they continue to deliver consistent earnings.
Thanks, Fawaz. I've got some compliance questions here. The first one is there consistency across the various Sharia boards in proposing the investment universe? And if not, how does yours differ? And why have you selected the board you have? Okay, so I probably wasn't around when the board was selected, but there is a broad consistency around our Sharia board. However, there is inconsistencies with the interpretation of certain rules. So IOFI would put out a rule saying that a 33% debt to market cap is allowable. Okay. Our board, I know, is more conservative, so they said no, we're happy with 30% debt, and then in terms of market cap, we believe that it should be market cap and asset value. Now, in saying that, think about what COVID did to markets over the period when markets tanked. If the ratio had stayed to market caps got crushed. So does that mean, from an investment point of view, that as a portfolio manager, you need to go sell out all of your stocks that breach? Absolutely not. If you do it then over assets, your assets are still there, they are valued, and then in terms of the rules, that will still pass. So I think that's one differentiator, and then also the way our board looks at property versus other boards is also very different. In the property sector, on the local side, that is, we only really hold two property stocks, equities and storage, and that is because the company has actually given us the underlying tenants in terms of the breakdown of their revenue and who are the non-permissible tenants versus who are the permissible tenants. Now in that case, some boards look at property to say, it's actually not our responsibility on who the landlord takes in, but property itself, in terms of the brick and mortar, is actually a Sharia compliant asset. So there are those small nuances that can affect the universe, which I would say directly or indirectly actually affects the performance of the funds. So that's my answer to that. And then there's a question here. You mentioned brands like Zara and L'Oreal, how these brands link to Sharia. So there I was talking about the universe, in talking about the global exposure, and just giving the audience some idea of name brands that you maybe relate with in your daily lives, but from a business or company, those are the type of companies that we can invest in. So Zara, in terms of clothing is Sharia compliant, and they're fast fashion brand, good quality, and if from a business point of view, but when looking at their metrics, are they a quality business? Do they have a good return on invested capital metric? Are they cheap at the moment? Or are they not? Are they expensive? And then the ability for Zara to grow. What is their growth strategy, in terms of how their EPS is grown? And then how does that moat look around Zara? Can they consolidate? Can they buy? Can they get into malls that are where they are not currently? all of those questions. The link was just made from a brand in terms of brands that we know out there, that we see daily, and the type of exposure that you could get in the global fund that you couldn't get on the JSE.
And all these companies have they pass that simple framework that Meyer gave, which is quite nice. I mean, the nature of the business is halal, so there's nothing wrong with fashion businesses, clothing businesses. And secondly, they pass the interest sort of screen as well, meaning that they don't take on a lot of interest-based debt. And based on those two, Zara and L'Oreal is compliant, so they'll be investable for us.
Yes. So, any other questions?
I think we'll get to the rest of the questions. Definitely we'll reach out and address the rest of the questions to the ones we haven't gotten to. I think that's our time for now. Thank you so much for joining us this morning. It was a pleasure to speak to you. As always, any more questions, any comments, any concerns, please reach out to our marketing team. And yeah, we're more than happy to assist you in any way we can. And I hope you enjoyed it, and hopefully hope you found it informative. And yeah, goodbye.
Thanks so much. We really appreciate it. And I think we're always there to educate individuals. The pack is there for download, as I mentioned. So please, if you download the pack and you go through it and anything else is unclear, please reach out and we can clear any of that up for you. Thank you very much. All the best. Enjoy your week.